Good evening, students. Welcome to the session. Have you revised what we discussed yesterday? Good evening, Manshika. Yes, all of you. What we did in the last class. So we finished off the computation aspect. In the last class, we were discussing the computation portion and we finished off that particular area. So what we discussed in that last class was section 50C, 50CA. All of these sections we discussed, right? What is 50C? For the sale consideration, instead of sale consideration, you will adopt the stamp duty value. But when you will adopt the stamp duty value, when the stamp duty value is greater than 110% of the sale consideration. Otherwise, what you will do is you will adopt the sale consideration only. So only when your stamp duty value exceeds the 110% of sale consideration, then you will take the stamp duty value. Now, if the date of agreement is different from the date of registration, then in that case, which stamp duty value do you need to take? So in that particular case, we need to take the stamp duty value, which is the, if you have to see whether the consideration is received by way of account paid check or electronic mode on or before the date of agreement. If the answer is yes, then the stamp duty value on the date of agreement. Otherwise, you will take the stamp duty value on the date of registration. Then we saw 50CA. 50CA is for the unquoted shares, the shares which are not listed on the recognized stock exchange. In that particular case, if your sale consideration is less than the fair market value as determined as per Rule 11UA, then in that particular case, you will take the FMV. Okay, so FMV as determined as per Rule 11UA. So that is as per 50CA. Then we decided, then we discussed upon the cost of acquisition. For cost of acquisition, you can take the index cost of acquisition and index cost of improvement as per second proviso to section 48. In case of non-resident, the first proviso to section 48 is applicable, which gives the foreign exchange rate or foreign exchange currency fluctuation benefit that we are going to discuss in detail in the international tax class, right? And then we saw that the STT deduction is not available. Unlike PGBP, you do not get any STT deduction over here. Also, in the cost of acquisition, you cannot take the deduction of interest on loan, which you have claimed as deduction under section 24B under the head house property, right? So you cannot take that. Fine. Then what did I say? That the index cost of acquisition is not applicable in cases where we are going for special computation under 50A, 50B, 50AA, 50 sovereign gold bonds, capital index bond. There we do not have the indexation, right? And then finally, we discussed about the indexation benefit, which is going to be available only in the cases where you are not claiming the indexation, will not be available in 112A and for a non-resident who is claiming the 10% under section 112. In that case, the indexation will not be applicable, correct? And then there is section 48.3, which is with what we have already discussed, that the amount attributable to section 45 for the amount chargeable there will also be considered here in the computation. You will get the deduction of that particular amount as well, right? So that is what we discussed for the computation. Then we discussed the tax rate under 112, 112A, 111A. For 111A, it is short-term capital gain on the listed equity shares, listed equity-oriented fund, units of business trust, where you have paid the STT. The STCG is going to be taxed at 15%. Now, for the 15% rate, you will also get the unutilized basic exemption limit. You can get the resident individual or HUF can get unutilized basic exemption limit. Chapter 60 deduction is not applicable. For any other asset, it will be taxed at the normal rate. For long-term capital gain for listed equity share on which the STT has been paid at the time of purchase, as well as transfer equity-oriented fund which is listed and listed units of business trust. What is listed equity-oriented fund? Where 65% of more proceeds are invested in listed equity shares, or 90% another mutual fund which invests 90% in listed equity shares. So those are the equity-oriented fund. In that case, you should have paid the STT at the time of transfer. Now, this condition is not applicable for STT, which is for the transaction on the recognized stock exchange in IFSC, where the consideration is paid in forex, and the cases covered in notification of 2018 issued by central government. So in those cases, you will not have the requirement to pay the STT at the time of purchase or transfer, and the tax is going to be at the rate of 10% over rupees 1 lakh. The resident individual HUF can utilize the unexhausted basic exemption limit. You will not get any rebate under 87A, no Chapter 6A deduction. And you will not get also any indexation and the foreign exchange fluctuation benefit. Now, in this case, if the shares are acquired prior to the 31st, the assets are acquired prior to 31st January 2018, then the cost of acquisition will be as per section 55, which will be the higher of cost of acquisition or the lower of sale consideration and the FMV as on 31st January 18. And if case the assets are acquired post 1st February 18, then you will take the cost of acquisition. We saw how it is to be done for even the rights share and the bonus issue as well. Then we came to section 112, which is for all the other shares. So in case of section 112, for the resident individual or HUF, it is 20%. For the domestic companies, also it is 20%. And for any other resident taxpayer, it is also 20%. Right? So then in that particular case, if there is the transfer of the shares and securities, listed shares and securities, then it is 10% without indexation or 20% with indexation, whichever is lower, right? Now, what did we discuss in the other than that is for a non-resident. In case of the listed shares, it is going to be 10% without indexation, 20% with indexation, whichever is lower. For the unlisted share, it is going to be 10% without indexation and without the benefit of the first proviso to section 48, which is the foreign exchange rate fluctuation. And for any other asset, it is 20% with indexation. Fine. Then no Chapter 6A deduction is allowed. Then finally, we started discussing the exemption under section 54. So for the 54 series, the eligible assessee is for the 54 individual or HUF. Asset to be transferred is the long-term capital asset being residential house property. And which asset you have to purchase? You have to purchase the another house property. Now, if your capital gain is more than 2 crore, you can only purchase one house property. If it is less than 2 crore, the assessee at the option once in a lifetime to be exercised can purchase 2 house property. What is the time limit? 1 year before, 2 years after the date of transfer, or construct within the 3 years from the date of transfer. Fine. Then what is the exemption? Exemption is your LTCG or cost of house. But the maximum exemption, as I told you, is going to be rupees 10 CR. And in case you are transferring the asset within the 3-year period, then the cost of acquisition which is there will be reduced by the LTCG exempted earlier. Yes, students? Is it clear? Yes? Yes, good evening, Geeta. Good evening, Viraj. Good evening, Sailesh. All of you, have you revised this much? So shall we proceed further? Okay. Now, one very important aspect under 54. So there is a case law that I would like to now discuss over here in terms of section 54. See, you can purchase one house if it is less than 2 CR. Right? You can only purchase one house. But now the question which arises in respect of one house property is that let's say, for example, that I have 2 flats in which what I've done is I've, let's say, joined both the flats. I have just demolished the wall which was existing between the 2 flats and I have joined both the flats. So there is like a common entrance. Most of the families, they purchase 2 flats and just join them together. So in that particular case, will it be considered as 1 flat or will it be considered as 2 flats? Of course, you can claim the deduction of 2 flats also if your capital gain is lesser than 2 CR, but that's once in a lifetime thing. But what if like I have more than 2 CR and I want to claim exemption for one house property? In that case, the question which arises is that whether I will be able to claim both the houses together, deduct exemption for that, or will it be considered as one house only since I have joined both the flats? So the courts in this case have held that the assessee is entitled to claim the exemption for both the flats because there is a common entrance to it, making it a single residential unit. The condition should be that there should be one residential unit in which the amount should have been invested. Now, if both the flats are purchased and they are combined, then in that case, you can claim the exemption for both the flats. Fine. So you can just write down over here. If two flats are combined and there is common entrance, exemption can be claimed for both flats as it would be considered as single residential unit. Fine, students? Okay. Now, that is about section 54. Okay, so under 54, you can claim the exemption for one house property. Fine. And in case you are not able to purchase the flat or put the amount for the construction before the due date of filing the return of income, then what you need to do is you have to deposit the amount into the capital gain account scheme. So you will have to deposit the amount in the capital gain account scheme. Fine. The next one is section 54B. Now section 54B, which is there, is again applicable to only individual or HUF. Now here, what should be the capital asset that is transferred? Here, the capital asset which is to be transferred is, here you can write down just capital asset and not just asset, is the agricultural land. Is the agri land. So whether it should be the rural or urban agricultural land, students? Yes, which agricultural land should be transferred? Obviously the urban agricultural land. Because rural agricultural land is excluded from the definition of capital asset. So it is only the urban agricultural land that is what we are going to consider over here, right? So this is the urban agricultural land. Fine. Now here, if you look at it, the urban agricultural land should have been transferred. Now this land should have been used for the agricultural purpose by the assessee, either by himself or his parents or in a HUF in the 2 years immediately preceding the date of transfer. So this should have been, it should not be just agricultural land, but should have been used for agri purposes 2 years prior to transfer. Okay. Now, what is the asset which is to be purchased? What is a specified asset? He should purchase another agricultural land. So he should purchase another agri land. Now this agri land can be either urban or rural. It is not necessary that he should only purchase the urban land. He can even purchase the urban or the rural land. And what is the time limit? The time limit is 2 years from the date of transfer. So time limit is within 2 years from date of transfer. And in case he is not able to purchase before the date of return of income, he can of course deposit it in the capital gain account scheme and then he can withdraw the amount and purchase within the period of 2 years. So again, what will be the exemption over here? The exemption will be the amount which is invested or the capital gain amount, whichever is lower. So here it can be the capital gain or amount invested, whichever is lower. Okay. So this is particularly which is given over here. That is section 54G. Now in 54B, in case you transfer the land again before 3 years from the date of acquisition, then again the exemption which has been given to you earlier, that will be reduced from the cost of the asset when you will transfer. So this will be the same. The cost of acquisition will be reduced by capital gain exempted earlier. But that would be the case only when it's an urban agricultural land. In case if a rural agricultural land is transferred even before 3 years, will there be any taxability? Yes, students. If the rural agricultural land which I have purchased for claiming the exemption under this section, if that is being transferred, will there be any taxability? Yes. Will there be any taxability over here? Yes or no, students? No. Yes, Latika, there would not be any taxability for the reason that it's a rural agricultural land. So, this is only applicable for urban agri land. Because if a rural agricultural land is transferred, it will not be taxable. So that is section 54B. Here they do not say anything about whether the gain is long-term or short-term. It doesn't say anything. Okay. Next is section 54D. 54D is, again here it is any assessee and not individual or HF. Unlike 54 and 54B, it is here any assessee. Now, what is the asset that has to be transferred over here? Here it should be the compulsory acquisition of land or building forming part of industrial undertaking. So compulsory acquisition of land or building, taxability under which section, students? The taxability arises in which section for the compulsory acquisition of land and building? Yes. Faster, in which section does it arise, the compulsory acquisition of land or building? 45(5). Isn't it? So there we discuss if a compulsory land is being acquired, then in that particular case, the taxability arises in the year in which the compensation is first received. In the year in which the compensation is first received. Remember section 45(5)? Yes. So here you can, if it is forming part of an industrial undertaking, you can in fact claim the exemption under 54D. So the land and building should have been used for the purpose of the business of the industrial undertaking 2 years preceding the date of transfer. Land and building used for business in industrial undertaking 2 years prior to date of transfer. And what is the specified asset that the assessee should purchase? He should purchase any other land or building, within 3 years from the date of transfer. So, he should purchase any other land or building in what time? Within 3 years from date of transfer. And in case he is not able to purchase before the due date of return of income, he can of course deposit it in capital gain account scheme. Now, what will be the exemption over here? The exemption will be the same. Your capital gain or amount invested, whichever is lower. Okay, so the amount invested or the capital gain, whichever is lower. Again, over here, there is nothing mentioned whether it should be short term or long term. Okay. So it is nothing mentioned that this should be short term or long term. Now, consequences of transfer. What will happen if the asset is transferred prior to 3 years? Then again capital gain which is exempted earlier will be reduced from the cost of acquisition. So cost of acquisition will be reduced by capital gain exempted earlier. Fine. If you remember, what we discussed is, let's say for example, if the land is compulsorily acquired, and let's say the land is acquired in year 2020, and the compensation is received, let's say in 2023. So the compensation when it is first received, let's say the land is acquired for 15 lakh rupees. The compensation first it is received in 2023, let's say 10 lakh, and the balance amount is going to be received in the next year. So it will be taxable first in the year 23-24 when the compensation is first received. And how you will tax? The compensation received will not be entirely 15 lakh, compensation, will be entirely 15 lakh and not just restricted to 10 lakh rupees. So entire 15 lakh will be considered in 23-24 even though you have received only rupees 10 lakh. You will calculate the index cost of acquisition and then you will, if you are investing the amount in another land and building, then you will get the deduction under 54D. Clear? Next section is 54EC. Here it is any assessee and not just individual or HUF. This is also applicable to any assessee. Now what should be transferred over here is land or building, which is a long-term capital asset. So land and building, long-term capital asset. So it has to be the land or building which has to be a long-term capital asset. Unlike 54B and 54D where there is no requirement like that. But if you looked in 54, there was a requirement of a long-term capital asset. Now here in the 54, there is long-term capital gain. In 54, if you look at it, there is a long-term capital gain which should have been invested, which is arising on the sale of the residential house property. And because of which, then you are investing in the new house property. So you will get the exemption. Now here, there it is the requirement of residential house property. Here it just says land or building. But it should be a long-term capital asset. Now the long-term capital asset can even be a depreciable asset. So a depreciable asset, how it is taxed? Under capital gain, when the depreciable asset is sold, how it is taxed under capital gain? Yes. Yes, students, you have revised, so you should be knowing all of this. How the capital gain is taxed on the sale of a depreciable asset? Faster. Yes. How is it taxed? Yes, students. STCG. Yes, good, Geeta. Under section 50, the sale of the depreciable asset is taxed as the or is deemed to be a short-term capital gain. Right? So then the question arises, can you claim 54EC in that case? Can you claim 54EC in that particular situation? The answer to that is yes. You can claim section 54EC. Yes, Sandhya, very good. The depreciable asset, the capital gain arising on that is taxed as or is deemed to be a short-term capital gain. So when do we have the capital gain on the sale of a depreciable asset? When either the block becomes empty, when the block ceases to exist, or when the sale consideration exceeds the WD. then the capital gain arising on that is deemed to be the short-term capital gain. Now, in case of the short-term capital gain, the question arises, can I claim 54 EC? Because the 54 EC says that it has to be a long-term capital asset. So for that purpose, understand one thing very carefully. 54 EC is not saying that the gain has to be long-term. What 54 EC is saying that the capital asset should be a long-term capital asset. And if you remember the first class, I told you there is a difference between the long-term capital gain and a long-term capital asset. The long-term capital gain means the gain, capital gain arising on sale of long-term capital asset. What 50 section says is, section 50 says that it will be deemed to be the capital gain which is short-term capital gain. It doesn't say that the assets are short-term capital assets. What section 50 says that the capital gain on sale of depreciable asset will be deemed to be the capital gain arising from the transfer of short-term capital asset. It doesn't say that the depreciable assets are to be considered as short-term capital assets. So that means the section 54 EC exemption can be availed even on sale of the depreciable asset if those assets have been held for more than 36 months. Clear? So just write down in the blue ink, even depreciable assets, even depreciable asset, or you can just write 54 EC can also be applicable on depreciable asset. Even on depreciable assets. Fine. Now, what is a specified asset which is to be purchased? So, the specified asset which is to be purchased are the specified bonds. Now, what are the specified bonds? NHAI bonds or RECL bonds, which are redeemable after 5 years. So, these should be redeemable after 5 years. And in what time frame this has to be invested? This has to be invested within 6 months from date of transfer. So, within 6 months from the date of transfer, the amount should be invested in these specified bonds, which is NHAI or RECL bond. Now, the question which arises is, in case of 54 EC, in case of 54 EC, the 6 months has to be reckoned from when? So, if you remember, we had discussed these points when we were dealing with specific sections as well. For example, the conversion of capital asset into a stock in trade. Yes, conversion of capital asset into a stock in trade. So from when you have to reckon the 6 months, whether when the capital asset is converted into stock in trade or when the stock in trade is sold. Yes, students, we have discussed that. So 6 months has to be reckoned from which date, students? We have discussed that while we were dealing the conversion of capital asset into stock in trade. Yes, let me see who remembers. Yes, students. So 6 months for the purpose of investing in bonds has to be reckoned. Yes, Chitala, from the date when the stock in trade is sold and not from the date when the capital asset is converted into stock in trade. So just write down over here. For capital asset converted to stock in trade, from date stock in trade is so, yes, Usha, very good. From the date the stock in trade is sold. Yes, Geeta, correct. So means all of you are revising it properly. Clear? There was another situation where we also discussed that. If you remember the compulsory acquisition of land, there also I spoke about this 54 EC. So what was that? From when do we have to consider? From the date when the asset is compulsorily acquired, or from the date when the compensation is first received? Yes. So how do you reckon the 6 months period? From the date when the asset is compulsory acquired, or from the date when the first compensation is received? Yes, students. Faster. 45.5. Yes. We have discussed that as well. From when do we have to reckon the 54 EC? Yes. From the date of receipt of compensation. Yes, Chitala. Yes, Usha. Very good. From the date when the compensation first received. Yes, Sarika. And not from the date of the compulsory acquisition. So just write it over here. Sorry. For compulsory acquisition from date compensation first received. Okay. Otherwise, what will happen is, otherwise you will have the difficulty in claiming the 54 EC exemption. So that is going to be a challenge if we do not allow this particular kind of exemption. Yes. Now, for the 54 EC, yes, Sandhya, very good. Yes, Geeta, that is absolutely correct. Now, what is important point over here is that you should invest in these NHAI bonds or RECL bonds to get the exemption within the period of 6 months from the date of transfer. Similarly, in the case of, let's say for example, when I'm trying to claim the 54 EC, whether 54 EC is going to be available to me in the case of liquidation. So let's say for example, let's take an example over here. Let's say I have liquidated the company. Okay. Now what happens is, on the liquidation, you get the shares, you get the capital asset, the shareholders will get the capital asset. Right? Now there will be taxability in the hands of the shareholder. In the hands of company, there is no taxability under 46(1). In the hands of the shareholder, there will be taxability under 46(2). Now, since there will be a capital gain, what will be the capital gain under 46(2)? Yes, students. What is the capital gain that is chargeable under 46(2)? Yes, let me see if you are able to recollect. Yes, students, what is the taxability under 46(2)? Yes. Yes, faster. What is the taxability under 46(2)? Yes, students, fast. Yes. 46.2, what is the taxability? The 46.2 says FMV of the capital asset which is received minus the deemed dividend under 222C. Remember, that is the taxability under 46.2, isn't it? So, when you are transferring the when you are receiving the capital asset in the liquidation, the capital gain arises under 46.2 in the hands of the shareholder, isn't it? So, in that particular case, what will be the amount? The amount of capital gain will be the market value of the assets minus the deemed dividend under 222C. That will be my capital gain. Now, can I claim the exemption under 54EC in that particular case? Yes. So there is a court ruling which says that you cannot claim the 54EC in the case of liquidation because this is a deemed transfer of capital asset and not the actual transfer. So 54EC can be claimed only in the case of the actual transfer and not in the case of the deemed transfer. Fine. So that is a ruling which is there, which is also there in your module as well. Okay. So basically it says that the 54EC can be claimed within the only when there is actual transfer and not deemed transfer. This is a case of a deemed transfer and therefore you cannot claim 54EC in the case of the liquidation of the company when the shareholders are getting taxed under 46.2. Clear? Okay. So now the important point, another important point in 54EC is that the amount has to be invested for a period of 5 years, meaning you should not transfer or convert or avail any loan on these bonds for a period of 5 years. So, in case you do that, then there will be the violation. So, the capital gain exempted earlier shall be taxed as long-term capital gain in the year of violation. In this case, it will not be reduced from the cost. In this case, it will be directly taxed as long-term capital gain. So, here what is the exemption over here? The exemption over here will be the capital gain or amount invested, whichever is lower. And if the year instead of 3 years, the condition is if the capital asset is transferred or if the capital asset is transferred or redeemed, converted or loan availed before 5 years, then capital gain exempted earlier, which was of course the long-term capital gain only. So the capital gain which is exempted earlier will be taxed as here you can write long-term capital gain exempted earlier, taxed in the year of violation. Okay. Now the maximum amount which is chargeable over year is, which is exempted over year is 50 lakhs. So the maximum investment which can be made in these bonds can be rupees 50 lakhs. So maximum benefit or maximum exemption rupees 50 lakh. Fine. Okay. So also there is a possibility that you may just sell the residential house. Then you can claim the benefit under 54. And the balance amount you can also claim under 54EC. So you can claim for the residential house under 54 as well as 54 EC. Clear? So in both the cases, you can claim that. It's not just that you can only claim against the 54. You cannot just restrict it to one. You can, of course, opt for both of them. There's no necessity that you can be just claiming only one of these exemptions. Are we getting that? So let's say, for example, if I have the capital asset which I have sold, so I can claim the exemption under 54 EC as well as 54 as well. Fine. Okay. So it is, you can claim under both of them. Basically the house, the residential house basically. So some amount you can claim, let's say for purchase of one residential house. Let's say I have 20 lakhs of property, 10 lakhs I have purchased another house. Balance, I have purchased the 54 EC bonds of 10 lakhs. So I can claim both. There's no restriction. Clear? Okay. So that is about 54 EC section. The next one which is going to be there is 54F. Next one which is there is 54F. Now in 54F, again this is only applicable to individual or HUL. Now what is the asset that you should have transferred over here in 54F? Here it should be a long-term capital asset, not being a residential house. So this should be any other asset other than the residential house. So, but this should be a long-term capital asset other than residential house. Are we getting that? So, you can write it over here for residential house. You can claim exemption under section 54 and 54 EC seamlessly. Okay. So for 54F, it should be any other asset which is a long-term capital asset other than the residential house. It can be a plot of land also. Plot of land, not land and building. Land and building which is a residential house, you cannot claim over here. Land and building which is not a residential house, you can claim here. So it can be any other asset other than a residential house for 54F. You have to be just mindful that this is not a residential house. It could be a plot of land. There is no problem for claiming it under 54F. Are we getting that? It's just the condition is that it should not be a residential house. Are we clear? Now, here you have to understand what is the capital asset that has to be purchased. So here you have to purchase one residential house in India. Here you have to purchase one residential house in India. So you are selling something other than residential house, you can purchase one residential house. So just write it over here. First write here, even plot of land is covered. Or you can say even plot of land can be considered as eligible asset. Here you have to write one residential house. Fine. Situated in India. Now, what is the time limit? Time limit is 1 year prior or 2 years after the date of transfer you can purchase, or you can construct within the 3 years from the date of transfer. So, one purchase 1 year prior or 2 years later from date of transfer, or you can construct 3 years from date of transfer. Clear? If you're not able to, of course, invest the amount before the due date, you can deposit in the capital gain account scheme. Now, what will be the exemption over here? The exemption over here is not going to be the cost of asset or the amount invested or capital gain, whichever is lower. Here, the exemption is little different. So what is the quantum of exemption? Here it will be the LTCG into the amount invested in the residential house property divided by net sale consideration. Divided by net sale consideration. If the cost of the new house is less than the net sale consideration. If the cost of the new house is greater than net sale consideration, then of course the entire capital gain will be exempt. But the amount invested, the maximum exemption which is available over here, that is rupees 10 crore. So maximum exemption, this is the amendment of 2023 under 54 and 54F. So if you remember, that day we spoke about 54 as well, that the maximum exemption will be rupees 10 crore. Even under 54F, the maximum exemption is rupees 10 crore. Are we getting that? Also here, one more condition is that the assessee should not own more than one residential house on the date of transfer. So here the condition is assessee should not own more than one residential house on date of transfer. So on date of transfer, you should only have one house property. Fine. So this is what you will get the exemption under 54F. Are we getting that? And then there is additional condition that the assessee should not purchase any other house property within the 2-year period or construct any other residential house within the 3-year period from the date of transfer of original asset. So he should not own more than one residential house property. He is investing in this house property, but he should not purchase any other residential house within 2 years or construct any other house within the 3-year period. Okay, so you can just write down. So this was the first condition. Assessee should not own more than one residential house property on the date of transfer. One second. You can write it over here. Yeah. The assessee shall not purchase any residential house other than new house within 1 year from date of transfer of original asset or construct new house or construct any house property within 2 years from the date of transfer. Sorry, within 3 years from the date of transfer. Original asset. Okay, so he should not have any other house property other than one house property. So he can only have one house property. He should not purchase any other house property other than this house for which he is claiming exemption, or he should not construct any other house for which he is claiming other than the house for which he is claiming the exemption. Are we clear? Clear? So that is the three conditions for claiming the 54F. Now, what are the consequences in case the asset is transferred within the period of 3 years? The new house is transferred within the 3 years from the date of purchase. Or what if the assessee where he is purchasing, let's say, another house also within 2 years or constructing another house within 3 years? So in case he is first of all transferring the new house within the 3 years period, then the capital gain which has arising on the transfer of new house and the capital gain exempted earlier under 54F, both will be taxable as long-term capital gain. Okay. So basically, what will happen if the conditions are violated? If new house property is transferred within 3 years, then capital gain exempted earlier, taxed in year of violation. So you will have two capital gain. One will be of the new house and one which is of the earlier property or earlier capital asset which was exempted under 54F. Okay. And what if I have, if assessee purchases another house property in 2 years or constructs another house property in 3 years, then in that particular case, another residential house property, of course, then in that case, the capital gain exempted earlier would be deemed to be the long-term capital gain and would be chargeable in the year in which the new house is constructed or purchased. Then long-term capital gain taxed in year of purchase of new house. Purchase or construction of new house. Clear? So the important point which is now here is that the exemption will be restricted to rupees 10 crore. Yes, Geeta, there is no bifurcation whether this is only available to a resident or to a non-resident. This is available to all. Okay. So let's say, for example, where we can consider the exemption. Let's say, for example, I have the net sale consideration, let's say rupees 12 crore. Okay. Then let's say, for example, my LTCG is, let's say, for example, my LTCG is, let's say 12 crore. And let's say this net sale consideration, let's make it 16 crore. Fine. Let's say cost of new house is 8 crore. Fine. Then exemption under section 54 EC note, sorry, 54F. Exemption under section 54F is going to be how much? It is going to be 12 CR into 8 CR divided by 16 CR. This is 6 CR. Fine. Now what if, let's say for example, this is 20 CR, this is 12 CR, and this is 15 CR. So then in that case, this is going to be restricted to, so my 12 CR is LPCG into, what is the amount that I have to consider over here? Yes, students? Yes. Here, the cost of the new house, will be 12 CR into 10 CR divided by 20 CR. Are we getting that? So this will be 6 CR. So this is the effect of the amendment. So this 15 CR will be restricted to 10 CR. Yes, students, is it clear? Yes or no? So this is how you will calculate under 54F. Clear? Next is 54G. Now these are some smaller ones. We have already completed the important ones. The 54G which is there, again this is for any SSC. This is applicable on, 54G is applicable on shifting of industrial undertaking from urban area to rural area. And for during that shifting, there is transfer of plant and machinery, building, land, or the entire business when it is getting transferred. So then these capital assets are transferred during the shifting of the industrial undertaking from urban area to rural area. So transfer of capital asset like plant and machinery or land and building during shifting of industrial undertaking from urban area to rural area. From urban to rural areas. Okay. So then in that case, there is the capital gain which is arising. Now capital gain can be long term or short term. What is the specified asset which is to be purchased? Purchase of new plant and machinery or land and building. This has to be purchased 1 year before or 3 years from the date of the transfer. This is 1 year prior or 3 years from the date of transfer. Fine. Then what is the exemption over here? The exemption will be the cost of the new assets or the capital gain, whichever is less. So exemption will be capital gain or cost of asset, whichever is lower. Now what if the assets are transferred within 3 years? Then from the cost of acquisition, you will deduct the capital gain exempted earlier. So if assets transferred prior to 3 years, then cost of asset to be reduced by capital gain exempted earlier. Fine. Then the last one is 54H, which is, 54GA, which is on the, again, transfer of undertaking. So there's shifting of the industrial undertaking from urban area to an SEZ. So during that thing, there is transfer of the capital asset, which is again plant and machinery or land and building during shifting of industrial undertaking from urban area to SEZ. Okay. Now again here what you have to purchase is land or building or plant or machinery which is new within 1 year before or 3 years from the date of transfer. So this is same. This is again same. Fine. Then what is the exemption? Again the capital gain or cost of asset whichever is lower. So again this is same. And here what you have to do is if the asset is transferred 3 years prior, within the period of 3 years, then the cost of acquisition of the new asset will be reduced by the capital gain exempted earlier. So again, this is going to be the same. Yes. Any questions? Any doubts, students? Yes or no? Now, last important point that I would like to discuss over here is, let's say, for example, if the amounts are invested in the new house. Now, it is usually a practice here that you look at like the agreements are made in the joint name, husband and wife, parents and children. So whether in that case, the capital gain exemption under 54F can be given to the assessee who is making the contribution for the new house, but the agreement is made in the joint name. So there have been several decisions where it has been held that just because the co-owner is added into the agreement, it will not disentitle the assessee from claiming the exemption under 54 or 54F. So the assessee who is making the or who is investing the amount, that assessee will be allowed to claim the exemption under 54F, even though the property stands in the joint name. Because all these sections nowhere stipulate that the entire new asset, the house property, should be solely in the name of assessee. It can be in joint name, and if it is in the joint name, the assessee who contributes towards the new asset, who invests the amount in the new asset, that assessee will be entitled to claim exemption under 54F. Are we clear? Yes or no? Also, in the case of 54F, what if the sale consideration is as per section 50C? Let's say the plot of land is sold. The sale consideration adopted is the stamp duty value. Then what you will take the net sale consideration? You will take stamp duty value on it. Irrespective, that is the deemed sale consideration. It is not that you will take the actual sale. So in case of the 54F, the net sale consideration, here you can write down, can be SDV as per section 50C. So if you have adopted the net sale consideration as SDV, you will take the net sale consideration as SDV only for the purpose of 54F. Yes, students, with this, we are completing the capital gain chapter. Any questions, any doubt before we move on to the next topic, income from other sources? Yes. If there are no questions, we'll just start with the new topic, income from other sources. But all of you, are you clear? Just a small recap. We had divided this chapter into several sections. First was the general charge under 45.1. There we also saw the definition of capital asset and the definition of transfer. Then we had the second part of the chapter, which is specific charge, which is 45.1a, 45.1b, 45.2, 3, 4, 5, 5a, and 46 and 46.1 and 2, right? Conversion of capital asset into stock in trade, the purchase of the destruction of capital asset by natural calamity, then the admission of partner, the capital asset that he introduces during that, capital asset on the reconstitution of the firm, right? Then we saw that 45.1a for the ULIP, right? 45.1b, sorry, for the ULIP. Then we also discussed the compulsory acquisition of the land, joint development agreement under 45.5a, and liquidation and buyback under 46a. Then there was the third part, which was the taxability of specific instruments, ESOPs, rights, bonus, goodwill, gift, transfer under the gift, basically, right? And then the fourth part was the reorganization, transfer of capital asset by holding company to subsidiary and wholly owned subsidiary and vice versa under 47.4 and 47.5. There were certain conditions around that the capital asset should not be transferred within 8 years, that the capital asset, the wholly owned subsidiary should not cease to be wholly owned subsidiary for the 8 years, and the capital asset should not be converted into stock in trade. The recipient should be Indian company, right? Then amalgamation, demerger, slump sale, conversion of sole proprietary to company, firm to company, company to LLP. And then we saw the computation provision and the tax rate, 50C, 50, 50A, 50AA, right? 50B for the market link debentures, the new provision which has been introduced. Then 50C, 50CA, the computation one. And we discussed about the 48, right? And then 112, 112A, 111A, that is the tax rate. And finally, the last part was the exemption under 54 series. Yes? Yes, Latika, 54 EC and not 54 and 54 EC can be claimed simultaneously and not 54F and 54 EC. See, 54F is not on the residential house property. 54 EC is on the residential house property. So you cannot claim 54F and 54 EC together. 54F is for other than residential property. 54 EC, the eligible asset is the residential house property. So how can you claim together? You can claim 54 and 54 EC because both of them are on the residential house property. Clear, Latika? Yes, students. Is this clear? The capital gain topic? Because again, this was a very extensive topic and I would request you to keep revising PGBP and capital gain both. Okay. So then let's move forward to the next topic, which is the income from other sources. Now, income from other sources is the residuary head of income. What is not covered under the PGBP, under the capital gain, under the income from house property will be covered over here. So again here, like capital gain, like PGBP, since we had the general charge and specific charge, here also we have the general and the specific charge. So, income from other sources, we have general charge, and then we have the specific charge. So, section 56.1 is the general charge. What does 56.1 says? Section 56.1 talks about the general charge. What is going to be charged under the head income from other sources? And it says under section 56.1, the income of every kind which is not to be excluded from total income. So, income of every kind, which is not to be excluded from total income, meaning this is not an exempt income, shall be chargeable under the head income from other sources if it is not chargeable to income tax under any other head. If not chargeable under any other head, meaning this is a residuary head. So in case the income is specifically covered under other head, it will not come over here. Only the incomes which are not covered elsewhere and those are also not exempted, then you will come to income from other sources. So anything which is not covered elsewhere and which is an income will be taxed under income from other sources. Then there is a specific charge. So under the specific charge, you have again divided into two segments. The ones which are income specifically covered under EFOS, and the second one, the incomes which are covered under the income from other sources if not dealt in other head. So income specifically covered in income from other sources and income not specifically dealt in or chargeable in other head. First one is dividend. Now dividend is, this is section 56(2). So dividend is specifically covered under income from other sources. Now even if it is my business of trading in securities or shares, the dividend that I derive will never be chargeable to tax under PGBP. It will be specifically covered under income from other sources because this is the specific charge. I'm not falling under general charge. It is specifically listed to be covered over here. Are we getting that? So dividend, even if it's my business to deal in the securities, but still the dividend will be covered over here. Are we getting that? So dividend is specifically going to be chargeable over here. The next one which is specifically covered over here is the interest on, the next one which is specifically covered over here is not the interest on securities, but the interest on securities in fact is not specifically covered over here. What does it say in regard to the interest for securities or the interest income which is there? Now it says that the interest on securities if not chargeable under PGBP. Interest on securities if not chargeable under PGBP. Then only you will have the taxability over here. So unlike dividend, the interest will come over here. Interest on securities if not chargeable under the head PGB. Only then the interest will be covered over here. Are we getting that? So, unlike the dividend, the interest is not specifically covered over here. Now, if you remember, we had discussed several examples when we were dealing with section 28(1), that whether this is business income or whether this is capital gain or income from other sources. That time I had touched upon the interest portion. Do you remember that? So let me ask you now, let's see if you recollect or if you're able to recollect that. I had told you that the interest which is there, if it is specifically chargeable under the head PGBP, then it will not go to the then it will not go to the income from other sources. So interest on securities is chargeable under the EFOS if not chargeable to PGBP. What about interest on surplus funds deposited out of the borrowed funds? Let's say I have borrowed the funds. Now, till the time it is pending utilization, I have kept those funds in the fixed deposit. Because let's say I have borrowed certain funds. And now, till the time I utilize that amount for the, let's say, construction of capital asset or construction of building or whatever, I deposit the surplus amount that I have in the fixed deposit. Whether it will be income from other sources or whether it will be PGBP. Yes. Yes, students. We have done that already. Yes, students, interest on surplus amount out of the borrowed funds. Whether it is going to be the PGBP or the income from other sources. Yes. Yes, students. Faster. Yes, Vanshika. Very good. No, Geeta. Yes, Mohammed. Good. Yes, Usha. Right. So this will be income from other sources and not PGBP. Do you remember the decision that we have discussed at that point in time? Tuticorin alkali. Yes, it was this decision only that I'm asking you. So, what was held? That was on the point of whether this will be income from other sources or will it be considered as the capital receipt. You recollect? So, in Tuticorin alkali case, what was held by the Supreme Court? That the interest earned on the surplus funds from the borrowed funds which was towards the setting up of factory before the commencement of the business, is income from other sources, and that will not be reduced from the cost of capital asset or the amount to be capitalized. That is not a capital receipt. So why did it held like that? That here it said that the assessee company, before it could commence the business, it invested the surplus fund which it had borrowed for, let's say, the construction of capital asset. So therefore, here the company has chosen not to keep its surplus capital idle, but had decided to invest it fruitfully. And therefore, the income which will be generated will be the income from other sources, which is flowing from the money that has been invested. So this was specifically made with the intention of investment, and this was not a capital receipt because this was done to earn the return on investment instead of keeping the funds idle. And therefore, this will be the income from other sources. What about interest on advances to the contractors during the course of construction? Let's say there was construction of plant and machinery. Certain contractors asked for the advances, and on those advances, I earn the interest. Now, this interest is not from an independent source, but it is connected with the construction activity only, since the advances were given for the construction. And therefore, this interest was to be capitalized and not taken to interest or income from other sources. Similarly, if you remember, interest on margin money deposited with the bank to obtain the bank guarantee. Will it be PGBP or income from other sources? Yes. Will it be PGBP or income from other sources? Interest on margin money to obtain the bank guarantee. PGBP or other sources? Yes, students. Faster. Yes, Geeta. Yes, Mohammed, correct. It's PGBP. Why? Because this bank guarantee is necessary to be obtained for getting the contract. And for obtaining the bank guarantee, I have to necessarily keep the margin money. So this margin money is inextricably linked to the business, and therefore it will be classified as the PGPP, or this will be chargeable under the PGPP and not under the income from other sources. Are we clear? So, if you remember this, we had done this particular portion under the head PGPP already. So that's how you have to interlink the provision. Isn't it? That's what I told you. So basically you have to interlink as to where exactly the provision has to be read. Are we clear? So this I have already covered as a part of the interest under the PGBP section. Isn't it? So interest will be taxable under the head PGBP. If it is taxable under PGBP, it will not be taxable under EFOS. If it is inextricably linked to the business, it will be under PGBP. If it is for the purpose of investment, then it will be taxable under the head IFOS. Also, as per ICDS 9, ICDS 9, what is ICDS 9? Yes. What is ICDS? ICDS 4, sorry, not ICDS 9, ICDS 4. Income earned on the temporary investments made out of the borrowed fund, which is pending to be utilized on the expenditure. So, the Tuticorin case example that I was talking about. In case of the borrowed funds, if the amount is pending utilization, then in that particular case, the interest will not be reduced from the cost of the asset, but this will be basically considered as my income from other sources. Are we getting that? So under ICDS 9, the borrowing cost, this example is clearly given over there. Yes. So the interest which is towards the temporary investments. So if I have borrowed the amount and there is surplus which is lying with me, so that interest which is there, that will not be considered as the capital receipt to be reduced from the cost of the capital asset. That is in fact the income from other sources. Are we clear? Yes. So this is what we have already considered. Now, one more important point that I would like to highlight over here. In case, let's say for example, I have purchased, not purchased in fact, let's say I have issued the shares. I am issuing the shares. So first I will get the share application money, isn't it? First I always get the share application money, those who are applying for my share. Now this share application money that I have received, let's say for example, I have to keep it in the bank account only until the shares are getting allotted. So till the time the shares are not allotted, the amount will be kept in the bank. Once the allotment is happening, only then the share application gets converted to the share capital. Now, I am statutorily required to keep the share application money in the separate bank account till the allotment of shares is completed. Now, after the share application is done, I have received the share application when the share allotment happens. Not everybody gets the shares allotted. So obviously part of the money is refunded to the unsuccessful applicants. Now the amount that is lying in the bank account, the share application money, if the interest is earned on that money, whether that will be income from other sources or whether that will be a capital receipt. Yes, the interest on share application money. No, Geeta, this will not be income from other sources. So you can just write it over here itself. Interest on share application money, interest on share application money is inextricably linked inextricably linked to the requirement or inextricably linked with the requirement of raising share capital. It is inextricably linked with the requirement of raising the share capital. So any surplus money deposited in the bank, any surplus money which is deposited in the bank, that is of course subject to tax under income from other sources if I earn interest on that surplus money. But here the share application money is statutorily required to be kept in separate bank account. Fine, this has to be kept in the bank account as per the statutory requirement. This was not to make the additional income. This amount is not surplus funds and not kept to earn additional income. The interest on these deposit is merely incidental. Is incidental. So interest will not be taxable as the income from other sources. Okay. Therefore, not chargeable as income from other sources. This is capital receipt and can be reduced from public issue expenses. So expenses for issue of share capital, from that you can reduce it, and the balance expenditure of course you can claim under 35D, which is the preliminary expenditure. So any share issue expenditure, if it is for the new company or the existing company when you are making the new share issue, so you can obviously claim the deduction under 35D for the period of 5 years. So there you will reduce this interest income because this is not income from other sources. So if you remember, I had written over here clearly that if interest is on surplus funds deposited with the bank, then only it is income from other sources. Clear? So just come back to the income from other sources and just write it over here. Refer to the PGBP class. Just write down, refer to PGBP. Fine. Okay, let's take a small break of 10 minutes and then we get back. Let's take a break. So the next point now is under the income from other sources. See, interest on securities. Okay. Then what else is specifically not chargeable here is the income from letting out of plant or machinery, furniture, right? Then in that case, if it is not chargeable under PGBP, it will be chargeable under the head income from other sources. So here also, if you remember, we had done the decision of Lakshmi Silk Mills. What was it? Income from letting out of plant and machinery or furniture. Yeah. So if not chargeable under PGBP. If not chargeable under the head PGBP. Then it will be chargeable under the head income from other sources. So income from letting out of machinery, plant or furniture, if not chargeable under the head PGBP, or where the assessee hires the, lets on the hires the plant and machinery along with the building, if the building is inseparable from the machinery, then also if it is not chargeable under PGBP, it will be chargeable over here. So let's say, for example, if I have let out the plant and machinery because there was some strike of the workers. So in order to minimize the business losses, I let out the plant and machinery for the time being. So whether it will be PGBP or income from other sources, yes. Whether it will be PGBP or income from other sources, letting out of plant and machinery. Yes. If let's say my factory has gone into strike and to reduce the losses, I have let out my plant and machinery. Yes, Viraj, very good. It will be PGBP and not income from other sources. If the commercial assets are let out, if the commercial assets are let out, then in that situation, the commercial assets which are let out to reduce the business losses, that will be the PGBP and not income from other sources. Okay, so just write down. If you remember over here, we had discussed in the PGBP class, income from letting out of plant, machinery, furniture shall be chargeable under EFOS if not chargeable under PGBP. If exploitation of commercial asset is to reduce the losses, then PGBP. If business is closed and then the plant and machinery is let out, that will be income from other sources. So just write it over here. Refer PGBP class. So if I've closed the business and then let out the machinery, so then it is no more a commercial asset, then obviously it will be under income from other sources. So refer PGBP class. Fine. Now what else is specifically chargeable over here? What else is specifically now chargeable over here? Let's discuss one by one. Okay. So casual income. Casual income. Now what is a casual income? Yes. So casual income, which is basically the income from winning of race horses. That kind of income I'm talking about. So understand one thing very, very clearly. There are these kind of winning from race horses, winning from games. Now these incomes which are there, these are specifically chargeable under the head PGBP. These are specifically chargeable under the head PGBP, and this is taxed at a special rate of 30%. This is taxed at a special rate of 30%. So winnings from the lotteries, winning from the race horses, these are specifically chargeable under the head EGB. And this is taxable at a rate of 30%. Okay, so just write down over here. Casual income, winnings from race horses. This is taxable specifically under or lotteries or the crossword puzzles. This is specifically taxable under income from other sources, right? And this is taxed at the rate of 30%. This is taxed at the rate of 30%. Okay. Now this is specifically covered under PGBP. Under income from other sources. Next one is what is specifically covered over here. Interest on the enhanced compensation. Interest on enhanced compensation. So just write over here. Okay, one more point before we move on to interest on enhanced compensation. There is one case law which is given in your module, which is regarding the lottery winnings. Let's say, for example, I am somebody who is selling the tickets from lottery. I am selling the ticket from lottery. So then in that particular case, the winnings, let's say, for example, there is unsold lottery ticket. On that, I have won. So let's say I am dealer in lottery ticket and I have won one of the lottery ticket which was lying in my stock, which is unsold lottery ticket. Now, whether that will be PGBB or income from other sources. So, Kerala High Court in Manju and Company has clearly said that winning on unsold lottery ticket will be income from other sources. It will not be PGBP and this shall be taxable at the rate of 30% under 115BB. So just write down 30% under section 115BB. Winnings on unsold lottery tickets, income from other sources, taxed at the rate of 30%. Manju and Company case. Are we clear? So this is taxable under 115BB. The winning from the lottery, crossword puzzles, race horses, card games, or any game of gambling or betting. This is specifically taxed under 115BB. Okay. So there is also a TDS on that. The TDS on that is again 30%, which is provided under 194B, which is winning from the lottery or crossword puzzle. So you can write here TDS at the rate of 30% under section 194B, which is winning from lottery. The TDS is under 194B on amount greater than rupees 10,000. Fine. And TDS at the rate of 30% on 30% under section 194BB, . for race horses, again on amount greater than rupees 10k. This is also for the TDS provision. Fine. Then I was coming to the interest on enhanced compensation. This also we discussed. Interest on enhanced compensation is taxable under income from other sources. The compensation which is there on the compulsory acquisition of land, if there is delay, there is interest provided. So interest on enhanced compensation is taxable under the head income from other sources. Here you get deduction under section 57. So the deduction under 57 is 50% of the compensation interest amount. 50% of the interest amount you get as the deduction here in the other sources. So deduction under 57, 50% of interest. Now here on the income from the other sources, the ICDS becomes applicable. Like the way we had ICDS applicable under PGBP, even under income from other sources, we have ICDS becoming applicable. As per section 145B, interest on enhanced compensation, this is taxable in the previous year in which it is received. Taxable in the previous year in which it is received. Yes, student, is it clear? Yes or no? Yeah. So as I said here, the ICDS also becomes applicable. So interest on refund of tax, again, that is taxable in the previous year in which the interest is received. So you can write down interest on income tax refund taxable in previous year in which interest is received. This is as per ICDS 4. Okay. This is as per ICDS 4. Fine. Yes or no? Okay. Now the next component under income from other sources. So interest on the compensation or enhanced compensation which is there. There is one case which is referred to here in the module, which is in the nature of whether, let's say for example, I am receiving the compensation. Okay. So let's say for example, let's take a scenario over here. So let's say the compensation that I am receiving, I had received a lesser compensation earlier under the compulsory acquisition of land. Now I have disputed, so I received obviously the higher compensation. And because there was a shortfall of compensation, I received the interest on the enhanced compensation. Now the dispute arose because there was a doubt whether this interest should be taxable under income from other sources or whether this interest is a part of the sale consideration itself. Because the enhanced compensation is technically which is received, since that was shortfall, I have received the enhanced compensation, and since there was shortfall, I have received the interest thereon. Are we clear? So therefore, the question arose whether this is in the nature of capital gain or whether this is in the nature of income from other sources. So the Gujarat High Court in Movalya Bhikubai Balabai case said that the interest which is received when the land has been compulsory acquired has been received not on account of delayed payment but on account of the shortfall of the compensation. So this partakes the character of the compensation itself and not in the character of the interest. So this will be capital gain and not the income from other sources. This will be chargeable under capital gain and not income from other sources. So you can just write it over here. Interest. One second, let me just take it down. Yeah, you can write here. Interest on enhanced compensation capital gain. Interest on delayed compensation income from other sources. If in the nature of compensation. Fine. Okay. Now the next one is advance money forfeited. Advance money forfeited. Now remember in the last class I told you there is one section 51 which is pending now, which I will deal with when I will go back to income from other sources. So let's say for example, if you have received the advance money from the buyer, and now let's say for example, for whatever reason the buyer is not honoring its obligation, so you forfeit the advance money that you have received. Now the advance money which is forfeited until 2014, this was reduced from the cost of acquisition. But now after 2014, this has been specifically chargeable to tax under income from other sources. So advance money which is forfeited is not taxable now as a capital gain. It was only until 2014 this was taxable under the head capital gain. After that, this has been specifically chargeable to tax under 5629. So advance forfeited due to failure of negotiations for transfer of capital asset. Okay, so this is going to be taxed under income from other sources. You can write here earlier reduced from cost of acquisition under section 51 capital gains. Yes, are we clear? Okay. Then what else is covered under income from other sources? So the rest of the things are specifically which are not catered in another head, which are not chargeable under another head, are covered over here. So which are those cases? So as I said, first is interest on securities. Second one is the income from letting out of the property. That is again if it is not catered under or not chargeable under PGBP, not catered, it should not be not catered, it should not be chargeable under the PGBP. So it will be covered over here. Third one which is there is income which is in the nature of any sum received by the assessee as the employee contribution if it is not chargeable under the head PGBP. Sum received as the employee contribution. If you remember, what is the effect of employee contribution under PGBP? Yes, let me know. Employees contribution to PF, ESIC. What is the effect there under PGBP? Yes. Yes, students. What is the implication of the employees contribution? Yes, Mansha, game of chance, game of skill, both. But yes, we will discuss more in detail about this game of chance and game of skill when we will also study the online gaming under the assessment of various entity class. Clear, Mansha? Yeah, what is the effect of employee contribution on PF? Yes, students. Employees contribution on PF. Sorry, employee's contribution to PF. Yes. What is the implication? Students faster. What is the implication of employee's contribution to PF? 3615. What did we do there? What did we discuss there? Yes, students, faster. Give me the answers. Yes. What was the implication? Nobody is answering. Everybody forgot. Employee contribution. Yes, go back to your PGBP class and look at it and let me know what was the impact of employee contribution to PF. Yes. Yes, students, faster. Yes, anyone? Yes, Mohammed, correct. So first it is treated as income and then it is allowed as expense deduction under 36158 if it is deposited before the due date of which due date, Mohammed? Yes, which due date you are referring to? Due date of the return of income? Yes. Or was it due date of the fund? Which due date? Yes, students. Yes, Usha, very good. If the sum is not deposited by which due date, then it is considered as income under 224. But which due date? Yes, Manshal. Very good. Due date of the fund. Yes, correct, Mohammed. So that is under PGBP. Now, similarly, under the income from other sources, if the amount is collected from the person who is not an employee, okay, and let's say, for example, there are some contractors which you hire, which are not necessarily in the nature of employee. So if you're collecting from that, then that will be under income from other sources if you have not deposited before the due date of fund. So contribution from employees to PF or ESIC if not deposited before due date of fund. If you deposit before the due date of fund, then deduction is allowed under 57. Deduction under section 57. Fine. So that is the employee contribution to the PF or ESIC, which is not covered under PGBP. Okay, so just write down over here, if not covered under PGBP. Then next one is keyman insurance policy. Now, for the keyman insurance policy, again, this is something which is covered over here. Okay. So, in the case of keyman insurance policy, the amount that is received, let's say by, for example, by the employee, that is covered under head salary. If it is received by the businessman, then it is under PGBP. If it is by the family of employee, then it will be chargeable under the head income from other sources. So keyman insurance policy, if not chargeable under PGBP or salaries, then it shall be covered over here. Fine. Okay. Is it clear? Yes or no? Yes, Usha, right. You're correct. Fine. So these are the incomes which are specifically chargeable and those which are chargeable here if not chargeable under any other head. Last one is compensation for termination, compensation for the termination of the employment. Okay. Compensation for the termination of the employment or modification in terms. So again, as I said, if it is received in connection with it is received by the employee, then this will be under salary. Okay, this will be under salary. If it is received by the family, then this will be under income from other sources. Because otherwise, this is for the employee covered under section 17. Clear? So here also you can write down under section 17(3). Here also it is under section 17(3), specifically covered under section 28(6) for the businessman, for the keyman insurance policy. Are we clear? Now, what else is covered here? Gifts under section 56 to 10. This is specifically covered under income from other sources. Shares issued at premium under section 56 to 7B. These are specifically covered under income from other sources. Then sum received under LIC policy. This is again specifically covered over here. And sum received by unit holder from business trust. From business trust. This you can write down, refer assessment of various entities. This is what we are not going to discuss today. Sum received under LIC policy, this we are going to discuss tomorrow. Rest, we are going to cover it today. Now first we'll start with the dividend taxation. So what is the meaning of dividend? So just write down dividend. Now dividend is defined. So the term dividend which is there is defined term. How is it defined? The dividend includes, this is defined under section 222. Okay, dividend is defined under section 222. So 222A talks about distribution of assets. Distribution of assets to the extent of the accumulated profit. 222B talks about distribution of debentures, and distribution of bonus shares to preference shareholders. Okay, distribution of debentures to any shareholder and distribution of bonus shares to preference shareholders. 222C talks about the distribution of the assets on the liquidation. Distribution of the asset on the liquidation or distribution on liquidation. Two 222D talks about the distribution on the reduction of capital. On reduction of the capital. So 222A is distribution of the assets. 222B is the distribution of debentures to the shareholders and bonus to the preference shareholders. 222C is distribution of assets on the liquidation. 222D is distribution on reduction of the capital. Are we clear? Then 222E is the payment to a company, payment to the shareholder, or you can write it like this. Just write payment to a shareholder in the nature of advances or loan. Or loan to a shareholder, advances or loan to a shareholder holding 10% or greater than equal to 10% of the voting power. Greater than equal to 10% of the voting power. Or, this is one. Second, advances or loan to a concern, to any concern, that is HUF, AOP, BOI or company, in which the shareholder having greater than equal to 10% of voting power, greater than equal to 10% of voting power, has a substantial interest. Has substantial interest. Now, what is the meaning of substantial interest? Greater than equal to 20% of the income of the concern greater than 20%, greater than equal to 20% of the income of the concern that shareholder is entitled to. Okay. Entitlement to, or you can write like this. Entitled to greater than equal to 20% of income of concern. Fine. So this is 222E. Now 222E which is there, it is applicable only to a closely held company. What do we understand by a closely held company? Yes, this is applicable only to a closely held company. Yes, students, what do we understand by the closely held company? What do we understand by closely held company? We had defined what is a closely held company and a widely held company. Yes, do you recollect? What is a closely held company, students? Yes, Mansha, it is unlisted or a private company which is not a subsidiary of a public company. It's unlisted or a private company because widely held company means a company in which public is substantially interested, which is a government company or a listed company, and an unlisted or a company which is a private company which is not a subsidiary of a listed company, because a subsidiary of a listed company will also be a company in which public is substantially interested. So this is applicable only to a closely held company. Now, what does it say is, the provision says that the deemed dividend will be taxable as deemed dividend in the first scenario when the distribution is by a company of the assets. Okay. Let's say, for example, when the assets are getting distributed. So in that particular situation, the distribution of the assets only to the extent of the accumulated profits. To the extent of the accumulated profit, whether capitalized or not. Okay. So when the assets are distributed, the market value of such assets will be deemed to be the dividend. So you can write it over here. Market value of assets. Fine. Again, in the case when the distribution of debentures is made to the shareholders or distribution of bonus shares to the preference shareholder, again that shall be to the extent of the accumulated profit. Now the market value of these bonus shares or the market value of these debentures will be taken to be the deemed dividend. Now distribution of bonus shares to equity shareholders, whether that is deemed dividend, answer is no. So just write over here, market value of debentures or bonus shares. Distribution of bonus to equity shareholders, not dividend. Distribution on the liquidation, again to the extent of the accumulated profits before the date of liquidation. So here you have to consider the accumulated profit up to the liquidation date. After liquidation, it will be the repayment of capital. So any distribution of capital asset after the date of liquidation, that is towards the repayment of capital and that is not deemed dividend. Only to the extent of the accumulated profits, this is deemed dividend. So after the date of liquidation, if whatever the accumulated profits are, that is towards the repayment of capital, and that is specifically charged in the 46.2. So here you can write refer 46.2. Again, distribution on the reduction of capital, again to the extent of accumulated profits, whether capitalized or not. So here you can make a common point to the extent of accumulated profits, whether capitalized or not. In case of loan or advance to a shareholder, again that is also restricted to the extent of the accumulated profits, but not the capitalized accumulated profit. For 222A to 222D, even the capitalized accumulated profits you will consider. But for advances or loan, you will not consider the capitalized accumulated profit. So here I am just writing to the extent of accumulated profits. Fine. So any advances or loans to the extent of accumulated profits will be deemed to be the dividend. Now, what is the meaning of accumulated profit? The accumulated profit means all the profits of the company which are distributable as dividend. Only in the case of liquidation, you have to consider up till the date of liquidation. Okay. Now, in the case of amalgamation, if let's say, for example, the amalgamation has taken place, what will be the accumulated profits of the amalgamated company? It will include the accumulated profits of amalgamating company as well. So, for amalgamated company, include the accumulated profits of amalgamating company. Now let's talk about the advances or loans to the shareholders. See, we have already covered distribution of assets. This is nothing major here. You just distribute the assets to any shareholder. It will be deemed dividend to the extent of accumulated profits. Or you issue debentures to the equity shareholders, or you just distribute the bonus shares to the preference holders. That is again considered deemed dividend. As far as distribution on liquidation, that we have already considered under 46.2. So up to the accumulated profit, that will be deemed dividend under 222C. Beyond that, it will be taxable under 46.2 in the hands of the shareholder, but you will reduce the amount taxed under 222C. Correct? So the balance amount is only going to be taxed under 46.2. For the company, it will not be taxable under 46.1. Distribution of capital assets or distribution on the reduction of capital, again that will be taxable under 222D. Now coming to 222E, when the advances or loans are given to the shareholder or to any concern in which the shareholder has a substantial interest. Substantial interest means he has the entitlement to more than 20% of the profits of that entity. This shareholder should be owning more than 10% of the voting power. Then up to the extent of the accumulated profit, this is taxable under 222E. So let's take an example. Let's say, for example, ABC is a company and one of its director is a shareholder who holds 65% of the paid-up capital. Now what happens is, let's say, for example, there is another company in which also he has the substantial interest, more than, let's say, 50% interest. Now, what happens is, let's say, for example, this other person, let's say, I'm just writing it over here for the ease of understanding. Let's say there is this ABC Limited. The shareholder is let's say, A. He is holding, let's say, 50% shares. Now, he is also holding the stake in, let's say, PQR Limited. Let's say here he has 30% stake. Now, ABC Limited gives the amount advance to PQR Limited. Now, this advance that the ABC gives to PQR, this will be considered as deemed dividend for the shareholder. This will be deemed dividend. Are we clear? Now, there are exceptions to this. What are the exceptions? Just write down. For the deemed dividend, there are exceptions, which is loan granted in the ordinary course of business. Loan granted in ordinary course of business. Now, what do we understand by the loan granted in the ordinary course of business? What do we understand by the ordinary course of business? So, ordinary course of business meaning that, let's say, for example, my business only is to do the advancing of loans. Then it will not be considered as the deemed dividend. So where, let's say, for example, my substantial part of the business is to just lend the money, then this will be considered as in the ordinary course of business. And how will I determine whether it is substantial activity is to give the lending? I will look at my turnover from the financing business. I will look into my assets which are used for the financing, and I will see overall what is the ratio of my assets and the turnover in the financing business compared to the total assets and the total turnover. What is the capital employed? So if it suggests that my substantial business is in the lending, then this is in the ordinary course of business only. Or let's say, for example, it is a trade advance. It is in the nature of trade advance. Then also this will fall under the exception. So basically, where I have the trade advances or lending is the part of substantial business of company, or it is in the ordinary course of business, then it will be falling under exception. It will not be taxable as deemed dividend. Is substantial part of business or trade advances. For example, it is possible that, let's say, for example, that the company's expenditure is being incurred by, let's say, the shareholder. Quite possible, let's say the shareholder has given the premises on lease to the company, right? Now, let's say the repairs and renovation is not incurred by the company, but the shareholder is incurring that. Now, company will obviously give the advance to the shareholder to repair the premises, because ultimately it is an expenditure of company. But in the duration of that, the company is giving the loan and advance. So therefore, or let's say the company is incurring the repairs for the leased premises which it has taken from the shareholder. Now that is not in fact in the nature of loan and advance. It is in the ordinary course of business. Or let's say, for example, the shareholder has given some benefit to the company. Let's say the shareholder is incurring certain expenditure for the company. And during the course of that, the company has made some advances to the shareholder. If it is a gratuitous advance or loan to the shareholder, only then it will be deemed dividend. But let's say the company is getting certain benefit out of that loan and advance. That is not going to be deemed dividend under 222. Are we getting that? So that will in fact not be considered as deemed dividend. Clear? So these are the exceptions to the deemed dividend. Now, one more important point over here in the deemed dividend is that if, let's say, for example, during the year, I have made the repayment of the loan, whether it will make any difference for the applicability of 222E, answer is no. So even if, let's say, for example, I have borrowed the funds from the company and repaid the funds back to the company, still 222E will be applicable. Because there is no exemption that if 222E is applicable, but if you have repaid the funds, it will not be applicable. No such exception. So subsequent repayment of loan or giving interest on loan will not provide any relief from applicability of section 222E. Are we clear? So that will not provide any relief from 222E. Now, what are the other exceptions to the dividend? Now, dividend as a whole, not just advances or loan, dividend does not include buyback of shares. So, buyback of shares is not included in the definition of dividend, or distribution of shares by resulting company to shareholders of demerged company. So, distribution of shares by the resulting company to the shareholders of demerged company is not considered as dividend. Okay, now when the dividend is taxable, so the taxability of dividend, it is given in section 8. So section 8 says that the dividend declared, distributed or paid by a company is deemed to be the income of the shareholder in the year in which it is declared or distributed or paid. So dividend is income of the shareholder in previous year in which dividend is declared, distributed or paid. For the interim dividend, the taxability is in the previous year in which the dividend is made available by the company to the shareholders. So, for the interim dividend, income of shareholder in the previous year in which dividend is unconditionally made available to the shareholders by the company. Are we clear? So, dividend is unconditionally made available by company to shareholders. Clear? For the 222A to 222D, the dividend will be income in the year in which the assets are distributed. Whereas for dividend in the 222E, it is the income of the year in which the dividend is the loan or advances paid to the shareholders. Clear? Yes or no? So just write over here, dividend under section 222A to D, previous year in which distribution of assets, and dividend under section 222E previous year in which loan or advance is paid. Yes or no, students? Any questions, any doubt with respect to the dividend? Yeah. Any questions, any doubt? Now, in respect of the dividend, the deduction is given under 57. So, you can write down deduction under section 57, which is interest on dividend. So, interest expenditure which is incurred to earn dividend is allowed as deduction under 57, which is subject to maximum 20% of dividend. Subject to maximum of 20% for the dividend. Clear? Yes. Any question? Any doubt? Yeah. Fine. So, will you solve one question on this deemed dividend? Yes. Okay. Let's solve a question on the deemed dividend. So, let me just give you the question for that. Just write down. Let's say ABC Limited provided loan of rupees 2 lakh to Mr. A, shareholder beneficially holding 20% of voting power. Fine. It also provided loan of rupees 1 lakh to PQR and Company, a partnership firm in which Mr. A is equal partner. In which Mr. A is equal partner having profit sharing of 33%. The loan to PQR and Company was given. The loan to PQR and Company was given for the expenses incurred by PQR and Company. The accumulated profits are rupees 1 lakh. The accumulated profits are rupees 1 lakh. So what will be deemed dividend over here? Yes, students. What will be my deemed dividend over here? What will be my deemed dividend? Yes, students, faster. Yes, Vanshika, correct. No, Mohammed, how 58,000? How come 58? Yes, faster. So here it will be to the extent of rupees 1 lakh which is paid, which is the accumulated profit. So the entire 2 lakh will not be taxable. This is given in the ordinary course of business to PQR. So that will also not be considered as deemed dividend. So only to the extent of accumulated profit, this is going to be taxed as the deemed dividend, which is going to be 1 lakh rupees. Are we getting that? Okay. Let me just tweak the example a little bit. So this will be your rupees 1 lakh. Okay. To the extent of the accumulated profits. Now, let me give you a little more complex example. So just write down. Let's say there is a balance sheet. This is my liability side. This is my asset side. This is my share capital. Let's say my share capital is 2 lakh rupees. Reserves and surplus 6.5 lakh. And I have cash of 8,25,000 as the asset. And balance is P&L debit balance. P&L debit balance of 25,000. Fine. Now, this is my balance sheet. So on 1/4/2023, the ABC Limited, ABC Private Limited, here also it should be ABC Private Limited, gives loan of rupees 2 lakh to Mr. A, holding 15% voting power. On 5th October 23, Mr. A repays the loan to the company. On 31st July 23, ABC Private Limited gives loan of rupees 3 lakh, gives loan of rupees 3 lakh to the supervisor having salary of rupees 4,000 per month. who in turn advance the loan, who in turn advance the loan to Mr. A, to Mr. A, who in turn advance the loan to Mr. A. So what will be the taxability here in this case? Also write one more case scenario over here. On 1st October 23, ABC Private Limited paid expenses of Mr. A amounting to rupees 5 lakh. Yes. So what will be the taxability? First scenario where ABC is giving loan of 2 lakh to Mr. A. Will that be deemed dividend? Yes. Will this be deemed dividend? Whether repayment of loan will have any impact? Yes, students, fast. First scenario, whether it will be taxable. Faster, students, please. So in the first scenario, repayment of loan will not have any implication. So even though the shareholder has repaid the loan, still 222E, as I said, will be applicable. So in this case, this amount of 2 lakh will be taxable. Fine. So repayment will not have any impact on the applicability of 222E. Next one is he gives the loan to supervisor who in turn advances the loan to Mr. A. So that will also be taxable in the hands of Mr. A. So taxable in hands of Mr. A. Why is that taxable in the hands of Mr. A? So here you can write down one more point. Make it 3 over here. So 222E also includes any payment on behalf of or for the benefit of shareholder, on behalf of or benefit of the shareholder. So any payment which is made on behalf of the shareholder or for the benefit of such shareholder who is holding more than 10% of the voting power, then in that case that is also included. So benefit of shareholder holding greater than equal to 10% of voting power. Fine. Are we clear? So even this will become taxable. Now, as far as for benefit, as for on behalf of Mr. A. And as far as this 5 lakh is concerned, again, this is for the benefit of Mr. A. The expenses should have been paid by Mr. A, but the company is paying that. So here, instead of 5 lakh, to the extent of accumulated profit, my accumulated profit is 6.5 lakh minus 25k. So my accumulated profit is 6.25 lakh. Out of 6.25 lakh, 2 lakh is already considered, right? So 6 lakh 25,000. 2 lakh is considered, 3 lakh is considered, so only 1 lakh 25,000 taxable to the extent of accumulated profits. Yes, student? Okay. Is this clear? Yes or no? Any doubt? Any questions? Yes, student? Okay. So we'll stop here for today. In the next class, we are going to start with the gift taxation. And then the next important point in the next class will be the proceeds from the LIC, which is now Amendment of Finance Act 2023. That is what we are going to cover. And with that, we will complete all the heads of income. So your income from other sources will also be over. All your heads of income will be over. Fine. And that shall be the last class tomorrow. Okay. And then you will have, of course, the another class on the subsequent topic. Okay. So any questions before we close the session? Please revise the capital gain tonight. Okay. Any doubts, any questions that you have? Okay. So thank you so much. See you in the next class. We can close the session.